Good afternoon, everyone, and welcome to today's webinar. My name is Kyle Kubler, and I am the Iowa SourceLink Program Coordinator at the University of Northern Iowa's John Papajohn Entrepreneurial Center, or better known as the most okayest webinar host ever in the history of the world. At Iowa SourceLink, we assist Iowa entrepreneurs who are looking to start, grow, fund, and even exit their businesses by providing step-by-step guides to operating a business in Iowa, make helpful referrals to our more than 400 city, county, and statewide organizations, who provide free business assistance to Iowa entrepreneurs, and are home to the Business License Information Center, which is a centralized database of all business licensing within the state of Iowa. In addition to all of this, we partner with the Iowa Department of Revenue to provide tax-related webinars like this one you're joining today. So thank you everyone for being here and welcome. Today we are covering Iowa tax law legislative updates that were enacted during the 2023 legislative session. Our presenter is Clara Wolfson. Clara is a legislative liaison, administrative rules coordinator, and tax attorney with the Iowa Department of Revenue. Working in the background to make sure everything doesn't crash and burn, run smoothly are my colleagues Sophie Troxel and Haley Ham. Before we get started, let's go over a few housekeeping items. Today's webinar is being recorded and will be available at a later date. Typically, this means within a day or two. The link to the recording can be found on Iowa SourceLink's website, so iasourcelink.com, or by searching for Iowa SourceLink on YouTube. The slides you see today will be available for you to download after the presentation. So make sure you visit our tax webinar page on iowasourcelink.com for more information about that. And then lastly, please enter any questions that you may have into the Q&A box located at the bottom half of your screen. We're going to hold off on answering questions live until the very end of the presentation. If there isn't enough time to get through all the questions today, don't worry. All questions will be sent to Clara alongside your contact information so she can follow up with you at a later date. So with that, Clara, I will let you take it away.
Thank you, Kyle, and thank you for having me. You are going to get bumped up because I have to be the world's most okayest web host, and I know you are better at this than I am, so you get the best web host designation today. Thank you for that introduction. Like Kyle said, my name is Clara Wolfson. I am the Legislative Liaison and Administrative Rules Coordinator for the department. So that is why I'm here to talk to you about the 2023 Iowa tax law update. I am responsible for helping develop and coordinate the department's bill every year and then get that passed over at the legislature. And I'm also in charge of helping watch all of the tax bills that are introduced during the session and then see them through to final passage. Before we get started, a quick disclaimer. All of my much smarter colleagues make me put this on all of the slides because I am not a tax practitioner, although I do work at the department. I don't do these returns, so please do not rely on anything you see in this presentation to actually do your tax returns. Contact a tax professional. All right, just an overview of the things we're going to cover this afternoon. All of the bills that we are going to cover that are specifically tax related are listed on this slide, and Kyle will be sharing this slide deck with you all later. I did hyperlink all of these bills, so it'll just be a quick click for you if you want to reference any of these later. They're not referenced on the individual slides, but they are on this overview page. And last but not least, there are quite a few changes for tax year 2023, even though they were not passed this year. So I have a few slides at the end to cover some of those major changes. All right, 2023 legislation. First of all, I want to mention the alignment bill. For those of you who are not familiar with the alignment bill that passed just this last session, it is not specifically tax related, but it definitely is worth mentioning here because the Department of Revenue is growing. And it's growing because there were previously 37 executive branch agencies under the control of Governor Reynolds. And now those 37 agencies are turning into 16. And the reduction in the agencies is due to other smaller agencies being aligned into not even necessarily bigger, just different agencies based on their similar functions, centralized programs, the people they serve, etc. So Iowa Department of Revenue now includes the Iowa Lottery Division and the Alcoholic Beverages Division, bringing the total internal divisions in the department from 5 to 7. Importantly, that also includes hundreds of millions of dollars of revenue and hundreds of employees. So please have patience with the department because this just took effect in July. So we've been hard at work to integrate those two formerly separate agencies now as divisions of the Department of Revenue. And that will be a phased-in approach. So if you have any questions about who certain subject matter experts should be enlisted to answer questions, where questions need to go to, I am more than willing to be a resource for any of your questions related to alignment. My email address is on the first slide of this presentation. Don't hesitate to shoot me any of those questions. That link to the bill, Senate File 514, I did include it on this slide and not on the other one. A fair warning, the bill is over 1,000 pages, so usually when it opens up, it tends to crash. But there's some very helpful summaries if you don't want to open up the full bill. All right, now on to our first actual tax bill, the department's Omnibus Bill. There's many divisions in the department's bill. A couple of the divisions were merely clarification of current practice or maybe a modification needed for modernization. So some of the divisions I did not list in this slideshow. That's just to avoid confusion because they were more just amendments that were needed to mirror current practice. So I tried to only list changes from current law in the slideshow. That's why you only see division 1 and 3 on this slide. All right, starting with division 1. So first time home buyer savings account and educational savings account. That's going to be your 529s, as many people call them. The due dates for making certain elections related to both of those accounts, namely for the 529, the due date for your contributions for that previous year was tied to the due date of the 1040 excluding extensions. Same case with the first time home buyer account. You have to make a beneficiary designation by the due date of the 1040. Now, this became an issue when COVID happened and the director extended the deadline for 1040s. However, we realized that for people who did not make that contribution in time for the 1040, original 1040 due date, they actually missed their eligibility for that year. So we cleaned that up in this bill and tied the required deadlines to the 1040 due date, including extensions. Next, division 3 is in anticipation of all the tax changes for 2023. It simply requires that taxpayers use the same filing status for Iowa purposes that they used for federal purposes. And that is because starting in 2023, Iowa is using federal taxable income as the starting point for your Iowa return. So in an effort to reduce confusion, we are also using the same filing statuses. Importantly, that means that the status of married filing separately on a combined return will go away. It will not be available for 2023. And once again, that's just an effort to increase conformity. Next, divisions 4 and 5, a pretty substantial part of our bill because it was relatively small this year. And those divisions had to do with 422.16, which is our withholding statute. And it was a complete rewrite, I should say partial rewrite and complete reorganization of that statute. There's a couple reasons for that. Number one, it's almost 6 pages long, maybe even closer in the neighborhood to 7 pages long now. And it did not really have a logical flow or organization. So we really tried to clean that up to make sure that everything related to withholding was in 422.16, so you wouldn't have to cross-reference a lot of different areas, and that it, like I said, logically flows. So there's quite a few changes that were made, but a lot of the changes were not any different than current practice. I didn't list those. For example, we included a definition of withholding agent. That definition of withholding agent was already found somewhere else in the code, but it made sense to include it in the withholding statute. So I didn't include those changes that were no different from current practice. On this slide, what I did include are the 4 changes that I thought were important to mention that are different. So number 1, it includes changes to allow the department to restructure the Iowa W-4 to work and look like the recently changed federal W-4. And we do anticipate to make those changes in the coming months. Next, there are changes to the withholding rate. We might just have to go in the sunlight. I forget that there's most intense lights, forgive me. There are changes to the withholding rate on supplemental wages to the highest rate imposed in, I believe it's, yes, 422.5A. Sorry, I have my screen covering the code reference. So 422.5A is the code section that prescribes what the statutory rates are, and the rate previously was 6%, as you see, and we amended that withholding rate on supplemental wages to just be whatever the rate is for that year, and that is why we referenced that 422.5A, so you are not overpaying on your withholding when the rates continue to go down according to the schedule originally provided last year in House File 2317. Next, the department was granted some rule writing authority to prescribe which tax credits may be deducted when calculating your withholding. So currently, taxpayers may only deduct the child and dependent care tax credit, and we do anticipate allowing a couple of more credits to account for more accurate withholding. Importantly, that means that you should be able to keep more of your hard-earned money sooner and not have to file a return for that money. And then last, there is a clarification that income tax does not need to be withheld if the payment is not subject to Iowa income tax. I know that sounds kind of vague, but it was for a very specific purpose. There was a lot of confusion around withholding for retirement income because starting January 1st of 2023, certain retirement income tax was no longer subject, certain retirement income, I should say, is no longer subject to Iowa income tax for individuals 55 and older with some of that qualified income. There's very specific rules for what qualified income is. I know we already got a question on that. I'm happy to forward those on to our individual income policy director. And I will mention, I do think the department, obviously I'm biased, but I do think the department has a pretty good guidance page on what is considered qualified income for purposes of that retirement income exclusion. So I would really suggest just doing a quick Google search, Iowa Department of Revenue, retirement income should pop up that guidance page for you. But that clarification was necessary so we could work with plan administrators and have the correct amount of withholding taken for retirement income. Importantly, allowing withholding, or I should say disallowing withholding, if taxpayers chose not to have that withholding taken out for retirement income that is qualified. All right, next, settlement authority and notice of assessment. That's a really long word, notice of assessment of estimation of tax. That's just a fancy way of saying estimated billings. So there's 2 different changes that happened in Division 6 that are worth mentioning. There was an expansion of our abatement, the department's, I should say, abatement and settlement authority. And there was also some new requirements created related to estimated billings. So the first change relating to settlement and abatement gave the department the ability to settle or fully abate tax, penalty, and interest. So that's a change from current law. And amounts that are paid or unpaid. So it really widened our latitude to be able to provide relief to taxpayers. And next, for estimated billings, there was a new requirement created that estimated billings create or include a very clear statement on that billing that it is in fact an estimate. And it also was accompanied by a new requirement that for taxpayers who receive those estimated billings, they need to file a return rather than immediately filing an appeal if that estimated billing is issued or returns that are not received. And that is effective January 1st of this year. I will note there are administrative rules. If they didn't get published yesterday, they're going to be published in the next bulletin cycle. So look out for those. Next, Division 7. I am personally the most excited about this division. We sat down pretty early on, going all the way back to last year, 2022, in anticipation of the 2023 session, and said, one of the issues that the department faces and one of the most constant points of criticism I hear is our processing times for things like power of attorneys, third-party access to information, things like that. So in an effort to help really clear some of the backlog that we had due to GovConnect Iowa and a couple of other changes with that process, the department is going to include on the tax return, similar to federal tax returns, a line that allows tax return preparers to speak to the department directly about that return if the taxpayer signs that line. So if the taxpayer signs off on that line, says, yes, department, you can talk to my accountant, then the department can do that without any of those extra forms that have historically been required. We're already working on that for the individual income tax, corporate income tax return. And I believe we will also be having it for monies and credits and franchise tax return to be decided still on the sales tax return status. But eventually we would like to have all of our returns include that line that allows a taxpayer to affirmatively sign off on the department's authority to talk directly to their tax return preparer. Now, I will say there is safeguards around that information, importantly. So we can only talk to the tax return preparer about information that appeared on that return and for a time period of, I believe it is 1 year. So that permission does expire if it has been a while, and it does not include authority to talk about anything else. So if you have a client and you do their income tax return, but they handle their sales tax returns, you won't be able to get any information about their sales tax returns without a further grant of authority from the taxpayer. All right, on to the next division, a set-off clarification. Now, this is minor, but I wanted to mention this because the Department of Revenue is taking over what is currently called offsets from the Department of Administrative Services, and that will be effective whenever IDR adopts administrative rules. We actually just published our notice of intended action today with a draft of our administrative rules for the set-offs program that will be moving to IDR in November. So if you get any mailings or have clients with set-offs or offsets issues, the Department of Revenue will be the new entity to resolve those issues going forward. Next, Division 9, Homestead Property Tax Credit. So this was a really simple change that took maybe more words than it needed to, but the meat and bones of the change is homes that are on leased land, so actual real property houses on leased land, which I know sounds like a very specific situation, but it happened, which is how we knew this was an issue. For homes built on leased land, they were getting treated differently for purposes of the homestead property tax credit. Some localities were allowing a homestead property tax credit on those homes and others were not. So the department offered a clarification, and the legislature ended up agreeing with us that a home, even if it is on leased land, if it qualifies, meets all the other qualifications for the homestead property tax credit, is in fact eligible for a homestead property tax credit. Next, electronic communications. I just wanted to mention this briefly because it's also an opportunity to talk about our modernization system that I'm sure you've all heard of at this point if you've been following the department. We are working on implementing a phased-in approach of a modernized computer and tax administration system. And one of the changes in our bill facilitated some of that. It allowed for electronic service of declaratory orders. And I just want to make one note that you have to opt in to receiving those notices electronically, so it doesn't happen automatically. You should get an email saying, hey, you know, there's a message posted to your GovConnect Iowa portal, please go check it. And then that notice of the declaratory order will be delivered to you electronically if you so choose. And the last two things I wanted to cover from our department bill, Division 12 and Division 15. Both of these were amendments. I wanted to make that clear, although the department had no issue with either of these. These were not offered by the department initially. So the first is a composite return filing exclusion for franchise taxpayers. It was discovered late after the composite return filing requirement had already passed. That did not allow for an accounting of the franchise tax credit. That was obviously an issue. So the franchise taxpayers successfully lobbied the legislature to get an exclusion, a one-year exclusion from that requirement, and then fixed that going forward. And then next, there's a composite return exception for certificate of acquittance that receive. This is a very, very specific subset of estates. But if an estate came up with a short year return, that's what the short year return is, because estates have a 9-month tax year technically. So for estates with that short year 2022 return, if you filed an estate return with the department and we issued a certificate of acquittance, and that return that you filed was not a composite return, and you should have filed a composite return because you had non-resident members, then the department will essentially hold you harmless if we issued that certificate of acquittance when you should have filed a different form. Basically a relief of liability. All right, on to our next bill, ESAs, House File 68. So this is the governor's bill that created educational savings accounts. I'm sure you've heard about those by now. It created an application, I should say, didn't necessarily grant automatically to every single student, created the ability to apply for an educational savings account so you could use that money. I forgot exactly how many dollars it was at this point, but you could use that money to send your child to the school of your choice, including a non-public school. Importantly, House File 68 also included a deduction for the amounts of ESA money that a taxpayer receives. And I say amounts because technically the word is qualifying expenses, and I went digging for what exactly qualified expenses meant so I could try and condense it down for you. But as you can see, I copy and pasted that definition directly from the statute, and it is rather complicated. And I will say The Department of Education also has the ability to write rules to further define or restrict what exactly that means. So I figured I would let you just take a stab at understanding that for yourself, because it is quite the definition. I will add there's even another subsection that I did not include in here. Importantly, it creates some limitations. It says that ESAs do not cover things like transportation costs, school supplies, etc. All right, on to our next bill. Senate File 181 was an assessment limitation and retirement withholding clarification. So first, the withholding clarification that I mentioned that also passed in the department's bill was originally introduced in the department's bill, and then it also popped up in this bill because we wanted to get it passed, we being the department and the legislative branch wanted to get that clarification passed for taxpayers as soon as possible. And the department bill took a little bit longer to pass, and we knew this bill needed to pass relatively quickly. So the withholding clarification also ended up in this bill, so we could get that passed and signed by the governor as quick as possible. And once again, that withholding clarification that we did provide is retroactive to January 1st of 2023. And the next most important thing that this bill accomplished, it took care of, I won't say an error because the statute very clearly delineated what was to be included in the calculation, but I'll call it an unintended consequence of what originally passed back in 2013, which was the phase out of multi-residential property classification. And after that property was fully phased into the classification of residential property, we actually ended up with a huge amount of value that got added to residential property at the end of that phase in, which was last year. So when we went to go make the calculations for 2023 on what the assessment limitation should be for residentially classed properties, we realized that it was a bit higher than we anticipated based on the last year's numbers. And then found out it was because of that multi-residential value that was out in kind of no man's calculation land, now getting added into the base of the residential value for that calculation. So this bill actually took that multi-residential property that was formerly in its own column, if you were a visual person, and removed it from where it moved under residential and put it back essentially under its own column. So multi-residential as a classification still does not exist, but the amount of value that represented that classification going forward will not be included in the calculation of residential assessment limitations going forward. If you like it cut and dry like I do, essentially that just means that your assessment limitations are actually going to be higher and letting you keep more of your, once again, hard-earned money and pay less property taxes. So I would describe this change as definitely property taxpayer friendly. Next, and I meant to mention this at the beginning, this is very property tax heavy, obviously. So a lot of these slides focus on property tax because that's where the legislature focused a lot of their energy and attention this year. So I apologize for all the property tax words for all of your UCPAs listening. But the next bill I want to cover, Senate File 445, allows Board of Review subunits. So for 10-member county boards of review that apply in very specific situations allowed, and I should say enumerated in code. For those 10-member boards of review, this bill actually authorized subunits of the boards of review And as a refresher, boards of review are the appellate, I'll call it, boards that hear property assessment appeals at the local level. So for those larger boards of review, this bill said if you have a 10-member person, you can hear property assessment appeals in members of 3, essentially. So basically dividing the work, because historically that 10-member board would have had to hear all of the property assessment appeals, and in anticipation of a lot of the appeals or more appeals for this assessment cycle, this bill was kind of a no-brainer to allow boards of reviews to split up, conquer and divide the work much more efficiently. So the chairperson of a board is the one that has to authorize the board to convene in those subunits, but importantly, any recommendations made by that 3, as small as 3-member subunit has to be approved by that full 10-member board of review. And that applied retroactively to January 1 of 2023. Next, House File 318. This is very technical and has to do with deadlines for tax credits that are entirely dealt with at the local level. So for claims for elderly, disabled, and low income property tax credits, they were required to be filed with the county treasurer, and anywhere, I shouldn't say were, they usually are required to be filed with the county treasurer anywhere between January 1 and June 1 in the year before those property taxes are actually due. Now, the code historically did provide for certain circumstances, I should say under certain circumstances, the county treasurer may decide to extend that deadline beyond June to September 30th. Now, this bill actually extended that deadline even further. So basically, rather than having that application be due in the year before the property taxes were actually due, it extended that time for filing for that claim all the way up until March 31st of the year when those property taxes are due. I think that bullet under this providing 6 months is probably the most important bullet point on the whole slide because it sums it up very succinctly. It essentially provides another potentially 6 more months of time to apply for folks that qualify for those credits that are listed above. The bill also made similar changes for deadlines for claims for manufactured or mobile home tax credits. And that was effective July 1st of this year. Next, House File 352. So on the initial slide, this is called the SALT cap workaround bill because that was the shorthand that most people who worked on that bill this year used to describe it up at the Capitol when we were working on it. Technically, it's a pass-through entity tax. And I feel like the best way to describe this is actually giving you some background on why this bill passed. So in 2017, the Federal Tax Cut and Jobs Act actually limited the amount of deduction an individual taxpayer could take to $10,000 state and local tax paid. So if you told the federal government that you paid up to $10,000 in state and local taxes, you can take that as a deduction. Importantly, that limit in the Tax Cut and Jobs Act of $10,000 previously didn't exist, but also in the Tax Cut and Jobs Act, they did not provide the same limit on deductions for corporations. So what ended up happening is that for pass-throughs that are taxed at the individual level, actually ended up not getting the full benefit of the state and local tax, that SALT cap deduction that C Corps can get. So the answer to that discrepancy is allowing a partnership or S Corp to be subject to income tax at the entity level. And when you are subject to tax at the entity level, then you are not subject to the state and local tax deduction limit of $10,000. You can take the full deduction that you're allowed for state and local taxes paid above and beyond $10,000, just like C Corps. So the way this works is that the owners, each individual owner of the pass-through, receives a percentage of the pass-through entity tax that they paid as a refundable credit on their individual income tax return. It applies, I should say importantly, to tax years beginning on or after January 1st of 2022. So it was retroactive a year. And once again, I'm biased, but I have even heard quite a lot of good feedback on our website guidance that is linked down there for how this is going to work, because the department is still working through a lot of the details on administration of this election and the corresponding credit. Just as a quick overview, the election has to be made by someone with authority to sign the tax return. And I don't want to get people tripped up. So make sure if you plan on making that election for an entity that you are associated with, or you're doing the taxes for, make sure you have the correct permissions in place to make that election. Once you make the election, it is irrevocable and it only applies to that one tax year. So it is an election you have to continue to take every year if you so choose. The election will be available on the return and electronically. The deadline is the due date of that return, including extensions. I will say for the 2022 tax year, the election must be made by December 31st, 2023, or the due date of your Iowa 1065 or 1120S. All right, next on to the big property tax bill that passed this last session. I was trying to think of a title for this, but it was such a huge and very complicated bill. I had to settle on property tax omnibus. I will try to do this bill justice, but it involves so many concepts and a lot of very intricate moving parts. So feel free to ask any questions that I may or may not be able to answer, but I can definitely get them to the right place if you have any points of clarification. So Division 1 removed authority for counties to exceed their statutory maximum rates for levies by just publishing an extra notice. Instead, required an election to exceed that cap. And with cities, they consolidated a few, actually not a few, 16 different levies, which were statutorily separate from the general fund levy that a city is allowed, which is capped at $810 per $1,000 of value on your home. Consolidated those 16 levies back under to that general fund amount of $810. So it took a whole bunch of separate levies, put them back under the general fund that has a cap of $810. And then for both city and county, there was a few changes. So if the levy rates exceed the statutory maximum, the bill provides a mechanism for those levy rates to be reduced to their statutory maximum, because once again, there was already a statutory maximum for both the county levy rates and city levy rates listed in code, but there was a whole bunch of workarounds and ways to actually exceed those caps. And I think the general goal here was to just take all those extra reasons to exceed that statutory cap and once again make that cap a true hard cap and not have a whole bunch of different exceptions. Next, Division 3 eliminated the possibility of adopting a new public education and recreation levy, which Pearl levy for short. Division 5 created a new 65 and over homestead property tax exemption for assessment years beginning July 1, 2023. And that exemption is tied to the current homestead tax credit. So the current homestead tax credit separate, you still get that. This new exemption is above and beyond your homestead tax credit for people who qualify that are over 65. The exemption is phased in over 2 years. As you can see, the exemption is $3,250 of taxable value for fiscal year 26, and for fiscal year 27, that increases to $6,500. And remember, I should point out the difference between an exemption, that is just taking the assessment of the value of your home and reducing it by up to $6,500. And then the credit comes right off of your tax bill that's due at the end. So it just works a little bit differently. Next, Division 6 increases the military service property tax exemption amount for all eligible veterans up to $4,000 beginning on January 1, 2023. And next, Division 7 made changes to, sorry, my screen, oopsies. The minimum assessment agreements for certain properties that are subject to an urban revitalization agreement, and importantly, excluded school district levies from those exemptions that are authorized under Chapter 404. Alrighty, and then next, Division 10 requires individual statements to taxpayers that include certain budget information. And the reason I wanted to mention this is because the legislation requires that in certain circumstances, every individual taxpayer must get a detailed statement of why their levies are increasing. So for those of you who might get one of those notices, hopefully you'll remember me giving you a heads up about that, so you're not taken by surprise. So in certain circumstances, like I said, only in the case of an increase, local government entities are required to send you an explanation of the increase in your property taxes. So if and when you get those for next assessment year, they're required to be directly mailed to you. And as you can see there, include a reason for the increase, justification for the increase. Next, Division 13 changes dates of certain elections. By certain elections, I mean bond elections mostly. So if a special election includes either just partially a question of bond or indebtedness, then the election has to be held in November. There can't be a special election date, for example, that just poses a bond or indebtedness question unless it is held in November. And as you can see, when there's a general election, it will fall on the same date as a general election. Next bill I wanted to mention, House File 666, very unfortunate number, was the Iowa Department of Land Stewardship, of Agriculture and Land Stewardship, their department bill. And the reason I wanted to mention this, although relatively small in impact, it underscores a larger recent change, and that is the excise tax on electric fuel that just went into effect July 1st of this year. So this actually originally passed, this new excise tax passed back in 2019. And this excise tax imposed a rate of 2.6 cents per kilowatt hour on electric vehicle chargers. Importantly, chargers that are at non-residences. So if you have a charger in your house, you don't have to worry about paying and remitting the tax. However, if you own chargers or your chargers are located, the owners of the chargers are located at a business, aka just not a residence, then you need to collect and remit that tax to the department starting on July 1. There's an intricate little detail here about testing. So similar to gas pumps, electric vehicle charging stations should also be tested to ensure accuracy. And previously, that responsibility fell on the department. The IEDA's department bill actually shifted that responsibility from the Department of Revenue over to IEDA's because they already do the testing of regular gas pumps. So it just made sense that they had the expertise to do testing and they would handle that portion of implementation. House File 660 was simply an extension of the Raceway Facility rebate. That extension is all the way now to June 2030. Historically, it was going to be to 2025. And the rebate, just in case you were interested in what the rebate was, that's why I included that last bullet point. It is a rebate for sales tax receipts collected for TPP that was actually sold at that raceway. And quickly, I just wanted to mention IEDA's department omnibus bill as well, because there was a couple of changes to, once again, rather intricate changes to some tax credits, removes some specific chemicals from definition of building block chemical, increase the tax credit limit for certain companies. Not all companies necessarily. I believe the threshold was you have to be in existence for more than 5 years, extended the tax credit and eliminated the wait list. And the Innovation Fund tax credit also had an extension. House File 703 and House File 710 also related to some tax credit changes. So House File 703 extended the award availability of the Hoover Presidential Library tax credit. That's such a mouthful, especially when you consider the requirement to qualify for that credit was a donation through the Hoover Presidential Library and Museum Fund that they're using to do some renovations to the Hoover Presidential Library. That award date got extended out until the end of 2024. Previously was going to be the end of this year. And just as a general overview, the program is capped at $5 million. House File 710 addressed some changes, and I should say implemented changes to the Endow Iowa tax credit. It modified the per person limit that was previously enacted so that it did not apply to gifts made before January 1st of this year, and also increased the aggregate limit allowed for that tax credit, I believe in an effort to eliminate the wait list. Next, this bill, Senate File 549, did a lot of things, but the only one I really want to mention to you today is a phased-in reduction of insurance premiums tax, and that reduction is happening over 4 years. So the insurance premium tax, for those of you who don't know, is the tax that insurance companies pay. So insurance companies don't pay normal corporate income tax. They actually pay what's called the insurance premiums tax. And historically, that rate has been 1% of premiums. Excuse me. But as you can see on this schedule here, that rate will get reduced from 1% to 0.9% by 2026. I believe this is our last one, actually. Oops, sorry. Yes, getting ahead of myself. All right, House File 270. Once again, property tax related. I know you're not surprised. but it did a couple of important things, and it provided some relief for folks who are affected by disasters. So very specifically for informal review changes, that just means normally when you call up your assessor or email your assessor and say, hey, I think something's wrong here, they can conduct what's called an informal review. So that's what that first bullet point covers. So previously, or I should say not previously, for informal review for properties that were affected by a disaster that occurs between March 1st and May 20th of an assessment year, that informal review was extended from April 25th to, I believe it's May 25th. I have my, yeah, there you go. Sorry. Have my camera in the way again. And then the Board of Review protest changes, that's the more official version where you actually file a protest with your local Board of Review, that board that we talked about at the beginning that could hear your case or your appeal, and members of 3. But generally speaking, taxpayers must have their protest actually filed with the Board of Review by April 30th. Now the bill provides, there was already, I should say, an extension for disaster areas, but this bill actually increased the scope of disasters covered, in that it now includes state declared disasters. Previously, it only included federally declared disasters. So same general timeline up above for disaster areas that are declared between March 1 and May 20th of that assessment year. The bill allows for property taxpayers to actually file that protest from May 1st to June 5th. And in that event, the Board of Review may extend their session all the way to July 15th. All right, and very quickly, some new rate information. Individual income tax rates. So as initially provided in House File 2317 from 2022, we are going to a 3.9% flat tax in Iowa. And that schedule, as you can see, is stepped down every year, so that eventually in 2026, we will no longer have rates and brackets. We will just have, well, technically we'll still have a rate of 3.9%, but we won't have the income brackets. So hopefully that will make tax practitioners and taxpayers' lives a lot easier when trying to pay their taxes. We won't have this graduated, phased in approach. We'll just have one rate of 3.9%. And remember, this is also this tax year 23. Obviously, we took a little bit of a jump last year. Top rate was 8.53%. This year it's 6%, and this is also the year where we start to use federal income tax. Our federal income tax is our starting point for Iowa. I shouldn't say income tax. Our federal taxable income as starting point for Iowa taxable income. All right, and then another two more rates that bear mentioning: corporate income tax rate reductions. So for 2023, there was an impressive reduction to 8.4%. And the way the corporate rate reduction, we'll call it schedule, works, it's not really a schedule because there's no time certain on these reductions. It's more of a trigger, so I'll call it a mechanism. But when the corporate income tax receipts for the whole state of Iowa in the preceding fiscal year exceed 700 million, then the department helps figure out the rate that would have yielded $700,000 or $700 million, excuse me, in receipts the year before. And then that rate that should, or I should say would have produced $700 million in receipts becomes the rate for the next year. We are expecting another rate reduction this year. That will get announced by November at the very latest. But we don't have, I've gotten a couple of questions on ideas or projections this close to the end of the fiscal year, especially because books haven't officially closed yet. Excuse me. The department doesn't want to release any more projections until we have our final numbers, which we won't get until the end of August, because that's when the state's books close and we actually figure out how much we took in corporate income tax receipts. But we are expecting at least a reduction from this 8.4, this top rate. And also worth mentioning, this rate is going to get reduced until we are at a flat 5.5 for corporate income as well. Next, the franchise tax schedule rate reduction, also down there, just a quick worth mentioning, because it's also different for 2023, and it will be different every year for the next 5 until they are at a flat 3.5 as well. Alrighty, I hustled, but I think, yes, we made it on time. So in the time remaining, I'm happy to go through some questions.
Cool. Do you want me to like read them off to you? Do you want to just go through them yourself and see? I mean,
That's a good question. Let me see.
Like I said, I'm the world's okayest webinar host, but I don't know anything about anything when it regards to taxes and legislative updates. So you might be able to filter things out a little better.
Okay, so all of the ones on the sub cap workaround pass-through entity tax election, I'm not even going to attempt to handle those. I will take those and I will forward them on to our pass-through entity policy tax advisor for him to answer. So I apologize if you had one of those questions, but I am not qualified to answer those. So you don't want me to answer them anyways. All right, please explain the tax rules for non-resident owners of an Iowa LLC. So for non-resident owners of an Iowa LLC, you should be filing a composite tax return. There's ways to not file that composite tax return if you make the election not to do so. Once again, there's excellent guidance on the rules for when you have to file that composite tax return for non-resident owners specifically on the department's website. So if you just Google Iowa Department of Revenue composite return, and then there's a drop-down menu of specifically there's a form that you just have to sign saying that you opt out of filing a composite tax return, and that should take care of that for you. Are you going to show Iowa 1040 for 2023? I am not, if you hadn't figured out already, I am not going to show the Iowa 1040 for 2023 in this presentation, but the department is working on one. There have been, I believe, at least some previews released to some tax return preparer groups. I'm happy to put you in touch with the individual income tax policy director. I will say, I know there was some hesitancy about releasing exactly what the draft form looked like because it doesn't fail. Every single time we release draft forms, there is an individual or preparer that actually uses the draft form, and those draft forms will not be accepted. So if you take that draft form and you use it to fill out your client's taxes, it will be rejected and considered not filed. So please, if you get a draft of that Iowa 1040, do not use it. I cannot stress that enough. PET process, another PET question. Will the authorization be a check the box like federal? The authorization, the third-party release of information, this is from Linda, will have to be a signature from your, if you are the taxpayer, it will have to be from you. If you're the tax return preparer, it's going to have to be from your client. It needs to be more than a check the box. We talked about making it a check the box, but there was some real hesitancy around having that permission on the Iowa tax return without having taxpayers really understand what they were authorizing for their tax return preparer. I know I'm already at 1 and I did
Yep,
not.
I was gonna say, I think we're out of time and that's okay. I'm just gonna do a quick little wrap up here and everyone can get on with their day. So thank you again to Clara for sharing the Iowa tax law legislation updates for the 2023 legislative session. As a reminder, this webinar was recorded and technically is right now as you're watching it. So say hello, everyone, you're being recorded. And it will be emailed out to you in a few days. If your questions were not answered today, make sure to download the PDF version of the slides, which will be available after this concludes, as your answer may be found there, or rewatch this webinar for clarification. Your questions will also be emailed to Clara alongside your contact information, so she can follow up with you if you ask something today she wasn't able to answer, or if she has to forward it to somebody else to answer for you, or for her, because she can't answer them herself. If you are looking for proof of participation for this webinar, guess what? You're in luck, because after this webinar ends, an email will be sent out to you that you can use for proof of your attendance for today's webinar. I think that the window for this is about 24 to 48 hours. So just stay patient and keep an eye out for an email from us, and you can use that for whatever you need your proof of attendance for. The next Iowa Department of Revenue webinar will be on September 13th. And will provide an overview of individual income tax updates based on previous year filings and tax law changes. So if either you or someone else you know would be interested in attending, make sure you visit iesourcelink.com and navigate to our tax webinars page to sign up. Until next time, take care, everyone. And thanks again to Clara for answering our questions and sharing this information today. So have a great day.